Welcome to the Wednesday webinar. Live stream, Todd
Good
Gordon
morning,
of tradinganalysis.com with my fearless colleagues, Alex, Terry. What's up, guys? How you doing? Sorry for the long build up, few little last minute adjustments, but I think we're live and rolling.
Making progress.
Someday we're going to have a studio hand, production assistant. So guys, what's up? Yeah, this is beyond, trust me, this is beyond an intern. Guys, what's up? How you doing?
All good on my side.
Come on, guys, wake up. Busy market.
We here in Texas, man. I've been out planting flowers and mulching the planters and making everything look pretty for the wife. So.
Oh Lord, man, we're still in 2 feet of snow.
You're still snow blowing 2 feet of snow out of your driveway.
You got it.
In New York, huh?
You got it, brother. So good morning. Get me caught up while I was setting up this live stream. We had ADP come out. Alex, Terry, give me the lowdown there.
That's your ballpark, Alex.
Yeah, ADP came at 242K. Forecasted previous was 119K and forecast was at 197K. So around 55K plus.
Okay, so and there was a
45K,
prior.
sorry.
That's a big move. So okay, a little prior revision, 242. All right, then we're looking forward to more jobs data at 10:30. We have Chair Powell continue to testify. He whacked us over the head again with higher for longer. Big move in the rates market. And then looking ahead to next week, we are at CPI again. So it looks like we're doing 6.4 in the headline year over year. Month over month, still looking for 0.5% change, which that's going to be interesting. Watch that. The core sporting a 5 handle, 5.6, and core month over month 0.4. So we're going to be watching that one, and then out to CPI, and then a little bit of building, a little bit of housing. That's going to be key there on the 16th. My wife's birthday. Don't let me forget this, guys. Okay, so that's that. So the big move, as we've been kind of focusing on the YouTube channel, is the move in rates and everything. I think the fate of this emerging, budding, possible return to the uptrend hinges on where rates are going. And now the stock market's being attacked sort of on both ends. The short end with Powell and the Fed continuing to reiterate that. Yeah, Alex, can you get your headphones on, Alex?
Yeah, sure.
Thanks, man. Powell continued to reiterate higher for longer, and the big move in the Fed funds yesterday was this. So we went after his testimony yesterday. We were at for the March meeting, a 29% chance of 25. Okay. Sorry, excuse me, 50 basis points, 29% chance of 50 after his testimony went up to a 70% chance of 50. So they did a quarter previously, now a half is back on the table. And, you know, I've been tracking this very closely. The whole team has been tracking it with our TA clients and just watching not only how the next Fed meeting, the percentages move, but 2 and 3 and 4 meetings out. And there's been a couple key realizations. I've been gone for 2 weeks. The week before, we're skiing in Utah. And there's been 2 major realizations. Number one, terminal Fed funds rate is not going to stop at 4.75 to 5. Kind of as Powell's been telling us, it's going to be higher than we think. Now the market has realized it's 5.5, maybe 5.75. That's the first realization. And the second realization is we're not going to get rate cuts this year. And the market was sort of dependent on that, which I find puzzling and interesting. It's a longer conversation. So as we continue to go out here, go out to June, July, you start to see where the sort of the histogram is here. You know, for now in July, we have a 45 plus 31 plus 6, whatever that is, call it 76 plus 6. So 82% chance of being above 5.5 in July. You go out to September. We have 42 plus 32 plus 8 above 5.5. And then you start looking at 5.75 to 6. You have 32 plus 8. So you have 40% chance of being above 5.75 at the end of the year. And then you start to push out to later meetings. You know, now we have 28 and 7, 35% chance of being above 5.75. So terminal Fed funds rate is going to be somewhere in here. So number one, it's higher than we thought. Number two, we're not going to get rate cuts. And I say good. I've said it multiple times in the public communications. I've said it with our members. I don't want them cutting rates. You know, we still have 5-6% inflation. It's not enough of a trade-off for people to be losing 6% per year on a bond, risk-free bond that's paying 4 or 5%. You're paying to break even, which when I still believe the economy is strong and earnings will continue to grow, it's leaving the market very sideways and very confused. And we'll jump into the charts here quick, and I'll bring in the team. So
let me throw something in there, because
sure.
I was listening to the Powell testimony to Congress, and you know, one of the things that somebody asked him about, you know, why he didn't want inflation to last very long, and he says because if it sticks around too long, then all the businesses will cue into that higher inflation, and then
right.
they will start. The cost will hang and linger even longer. But I'll say that it's also a double-edged sword. The longer they keep the interest rates higher, the investors will cue into those rate changes as well, and you can see some money flowing out of the stock market more into the fixed income portfolio. A little bit, right?
I disagree with that. I disagree with that. I don't think with a 4 or 5% 2-year rate is that enough of an incentive and a trade-off, considering 5 or 6% inflation, to forego your otherwise your would-be investment in the stock market.
Well, I'll just tell you that, you know, talking with myself and some other investor friends of mine, that money that we've had sitting in cash that
sure.
was collecting nothing, all of a sudden we realized, oh crap, we could get 4 or 5% out there if we started buying.
I get it.
1 year, 2 year, 5 years.
But you're breaking even, Terry. You know, you're breaking even. You're making 5.
I am, but I'm not breaking even. I'm losing money if I'm keeping it in cash. I'm losing at a rate of 6% a year. That's the thing that people need to understand about inflation. If you're not making the inflation rate, you're actually losing money.
Terry, I got it. But my point is, the earnings growth that we're seeing, the EPS earnings growth that we're seeing, is the opportunity cost is just too great, I think, because the economy has remained so strong. Inflation continues to be strong because I believe on the supply side, it's the input costs, it's the raw material, it's the tight labor market that are keeping rates, that are keeping inflation high, and the Fed on their front foot. combating inflation. And if the economy does open and we start to get labor and supply coming back, you're going to continue to see, I think, earnings growth move forward. Yeah, I totally get it. You know, I've got a bunch of money in short-term treasuries in the wealth management side, but I'm waiting for a second to take that out and put it to work. And I think it all.
I agree with that. That's all I was saying, is that short-term money, you just sudden realization that you could be making a little bit rather than nothing.
For sure.
So,
For sure.
yes, I agree. The better prospect remains in equities, and we had this discussion also yesterday that I really think interest rates would have to be much higher before people abandon investing in stocks.
What's that? Yeah. What's that point where you say the risk of being in the equity market, the nominal rate of the nominal yield on treasuries, whatever the duration, combined with the prevailing interest rate? What's that point where you say I'm willing to give up the upside of earnings growth in an economy that's, I think, handled this pretty well? And you put a 10 number on it. I said 8. You know, we're a long ways away from.
Everybody's got their own target number, right?
Right. So this has been the big focus, you know, for us, and it's I think interesting. It's unique. I think it's important that you realize we're starting off with a chart of yields, and it's all about this longer term move up in yields that we said. I did a video, a live stream yesterday on YouTube. I'm going to reiterate it. It's a super important point. I want to monitor questions. If you guys have anything, I want to go into it. I've got questions on both YouTube channels here. So if you guys have questions, definitely throw them in on this topic because it's very, very important. So 10-year yield, U.S. 10-year yield, which controls all interest rates in the economy. The biggest correlation would be the 30-year fixed mortgage, right? So we're below 4.08 to 4.17. This is going to be an ABC, what they call an expanded flat. In X, I believe this is 3 down, this is 3 up. This could easily be a flat, doesn't matter, doesn't need to be labeled as WX, it could be A and B. But this foretells at least an ABC or a 5-wave move down. Now, you know, we'll see how much lower this is going to move, but you know, make no mistake, as soon as we gapped up into 4.1, we got 4.09, 4.1, the NASDAQ, and then we gap back down, sort of an island reversal. I think this is called. The NASDAQ immediately rallied 5%. And then the last 2 days with Powell's testimony, yields tried to move back up, but then look where we are this morning. We're pushing back below 3.93%. This is such a critical relationship for you equity investors out there. You know, this is where Alex, Terry, and Todd specialize, because Alex and I have other market trading experience, being in the foreign exchange, fixed income, and commodity markets. Sometimes those other 3 major macro asset classes don't really have an impact on the stock market, but right now it's big time happening, and it's really important that you understand it. John Murphy wrote a great book. He started it, just a real simple look called Profiting from Global Market Relationships, Intermarket Analysis. If you haven't read it, I highly recommend it. It really started it all. So here's your 10-year yield with the wave countdown again, and let's look at the dollar and the S&P futures. And what you can see is in 2022, the dollar was rallying alongside interest rates as the U.S. interest rate relative to the rest of the world moves faster. That attracts foreign capital flows into the U.S. Dollar strengthened. People are looking for some return in the relatively risk-free rate in the U.S., as Terry was mentioning earlier. But the dollar strength comes at the cost of earnings for our multinational companies. That's why there's a long-standing inverse relationship between global stock markets and the U.S. dollar, along with emerging markets that are you know, tend to carry a lot of debt that's priced in dollars, so it gets more expensive to service that debt. So there's a long-standing inverse relationship between higher dollar and lower stocks. Stocks are here in orange. And the main point that I've really been trying to focus on here with everyone is, okay, so yields have moved back up. Look what the dollar is not doing that it did way back here in the first move up to 4.1 in the 10-year yield. The dollar has only retraced about 1/3, where the yields have retraced roughly, what? Probably 3/4, almost a 7/8, 6 retracement. Where's my ratio? Alt B. Doesn't matter. It's not popping up. Alt B. Okay, hotkeys don't want to work. Whatever, you get the point, right? We retraced almost this entire move. Now, if the dollar had a big move after Chair Powell yesterday, and that's why the stock market sold off. But the stock market, again, you know, there's an inverse relationship happening between the S&P and the dollar and rate. So what I like to do is take this, and I'm going to flip it upside down. I'm going to mute Alex just for 1 sec. I love that new hot mic you have, Alex. And if you look at the S&P, I just flipped the S&P on its head. All right, let me try to line these up for you. The S&P is now upside down, right? What is not, the S&P is here on this scale. The S&P is kind of trading with the dollar now. You can see, look at that correlation between S&P and the dollar. Orange and green. So the S&P and the dollar are both calling the yield market's bluff, going back up to 4142. So you have intermarket non-confirmation from two key macro asset classes that say, hold on, even though bond yields are trying to move up and everyone's telling us we're going to 4, 5, 6, 7, and the bond market, the bond bubble is popped. These two markets are not confirming it. Okay, so there's a lot of there's a deeper discussion that we can have here inside of this, and let's flip over to the stock market. I'm going to flip it over to Terry here in 1 sec. The major stock market averages have gone sideways, and what's happening, what we're doing is a lot of sector work behind the scenes and industry rotation work with our clients, which there's a couple key things that have happened, which is value has rotated out. Value had its time in the sun in 2022, where growth had already gotten clocked because of the move up in yields in the dollar that I just showed you. So right now, we're seeing a rotation into some really key sectors: communications, consumer discretionary, and technology, but in the smaller and medium cap stocks, not the large cap stocks. So that's leaving these indexes very sideways. And you got to realize, we love Elliott Wave, and there's a ton of Elliott Wave analysts out there. Everyone's beating their head against the wall. But the fact remains, these stock market indexes, these major indexes that are large market cap driven, are at the same price as they were in the first week of May of 2022. So we're on 10 months now of basically down, up, down, up, down. And what's happening again is we're keying on interest rates, where are rates going, on the short end via the Fed, long end via natural market forces with 10 and 30-year yields, and of course, interest rate differentials are key. So are we in a 5-wave move? It's possible. I'm starting to get my doubts. I'm starting to have my doubts. If we want to pull back here and hold a retracement a little bit lower, then okay. You can start to convince me that we're still in a 5-wave move, but I'm starting to have my concerns that we are going to come back above 4,000, go 4,300, and complete the 5-wave move off the lows. Now, over to the NASDAQ here quickly. NASDAQ looks a little bit more directional. See how the S&P was kind of sideways? Let me just flip back. This is just a very crude. I would say we had an initial move up here in November, and then since then the S&P has gone sideways. Compare that to the NASDAQ. The NASDAQ was a little sideways here, but then we started to get directional as the growth trade started to come back in. So for today in the NDX, we really should like to stay above 12,069, must stay above 11,963 would be the pullback. And then we have evidence of a 5-wave move. Now, let me just go over to technology, XLK. Let's take out the other industry or sector representation of the NASDAQ, right? Because the NASDAQ is about 49% tech. It's got half of other sector representation. Let's look at pure tech, which is your XLK ETF. Now you're starting to get a little bit more directional. You're starting to get a little bit more directional here. So Alex is working this wave count, and Alex, you're live here if you want to jump in. But we have a nice 1-2 and a potential 1-2. So are we setting up for a 3rd wave move here? I'm not going to say no. I have my concerns on it, but the fact remains that we are above 2022 downtrend resistance. that was actually formed here in 21. We have a touch point in 21. We have a touch point here in 22. We broke above it in 23. We're coming back now to offer support. So are we in a possible third of a third position? And I tell you what, very few people are looking for a significant market rally. I have my doubts, but we're very well aware of the situation here that we could move higher. And again, indexes are sideways because the activity is in the small and medium cap growth stocks right now. The last thing I want to put in front of you is let's talk seasonality here real quick, and it relates back to interest rates. So this is something we've been working with our clients here, and this is some seasonality. The most noticeable thing is the S&P for March, on average, we're up 1.07 right now, and currently we're only up 0.4 for the month of March. On the NASDAQ, the average is 0.76 and we're up 0.9, so we're right on where we were. I think there's a big asterisk in this because 2022 was such a down year and we're trying to recover. So I think the averages of the last 50 to 70 years, I think need to be acknowledged. The big part that I want to show you here is going back to rates. Seasonality for 10-year treasuries from 83 to 2023. March is the second weakest month for treasuries, which means it's the second strongest month for yields. Treasuries down, yields up. So we're in a seasonally very strong period for yields. April is slightly stronger. April is the weakest month for treasuries, strongest for yields. So I'm wondering, with that move up to 4.08 and 4.13, did we pull ahead a little bit on the seasonality? And
that little blue dot there, Todd, represents the current data point. That little blue dot right underneath that March bar that you've got.
Right. Yeah, and yep.
So we're right on track with that seasonality at the moment.
That's right on track with it, exactly. Right, and we're at that resistance. I was trying to bring that chart back over. So, I know a lot of equity investors don't like to get so caught up in the rate side, but it's all about that right now. So, let's turn it over to Terry. I want to have him focus on what's going on with the rotation, talk about that market capitalization, because there's some pretty cool forces happening below the scenes here. So Terry, I'm going to send it to you.
All right. Tell me when I got the screen there.
Yep.
All right. Hello, traders.
Share your screen. We're still...
Okay. I'm still seeing you. I'm still seeing your screen on the live stream here.
Here you go, and you are live.
All right. Hello, traders and investors. I do want to talk a little bit about what happened last week. It's just like, if you're taking a road trip, you do need to know where you come from before you get to where you're going. So a little bit about what happened here in February with the S&P. S&P did pull back in February. It got a 2.6% decline. But notice that the NDX, and this is that growth trade, the NDX only shed 0.5% in the month of February, right? About less than a quarter, 20% of what happened to the S&P. And that's all functionally related to, like what Todd was saying, what's in there. Also, look at last week's performance in the S&P. Last week we had a big rally in nearly all of the sectors, right? We were up 1.9% in the S&P. We're up 2.68% in the NDX. Last week it was materials and industrials and energy making some really big gains. I'm going to move this over here, and I'm going to show you a side-by-side comparison. Now this is on the left here. This is 2 days of trading. The market hasn't opened and got 10 more minutes. 2 days plus whatever pre-market action. Look here at the materials sector, how much it's pulled back. And let me just kind of make sure it lines up there. You can see the materials sector basically has pulled back a little bit more than half of all the gains that it made in the prior week, but not all. I think the important thing is look way over here. This is technology. The technology sector right there. Look at the gains. The technology sector last week advanced nearly 3%, and this week it's only shed less than 1%, right? So that is a demonstration of the relative strength that we've been trying to educate you guys over. All right, so this week we did see an acceleration. Actually, it was last Thursday. Last Thursday is when we got the bounce, right? So Thursday and Friday, the market shot up and netted this 1.9% decline or advance for the week after 3 days of falling, right? So we got that bounce. We had to move up, and then kind of a quiet day on Monday, and then we got yesterday's rejection. And yesterday's rejection, we're still, at a net gain between the 2 weeks here of 0.5% in the S&P. Right, we're down 1.47% in 2 days of trading against that 1.9 that we made last week. Let me show you the sector rotation here, and then we'll talk about the growth and value and capital market capitalization. So, as we've been narrating, we've got two growth sectors now. Communications and technology sectors have dramatically pushed into the leading quadrant, and we brought this to everybody's attention that this is on the board. Way back here in January, we saw the move up. We saw communications rising rapidly, with technology a little bit more of a laggard, then communication, then technology. Okay. The other thing that happened is, I want you to look down here. Let's go back here to end of January and look at this rotation out of favor of these value sectors. All of these: healthcare, staples, financials, industrials, materials, and energy, I consider value trades. But look at that. They all started shedding their relative strength and momentum versus the S&P and the stocks within those groups, the large caps, right? These are all cap-weighted, your cap-weighted sectors, so they're going to be heavily influenced by the largest market cap stocks within these sectors. These all started peeling back. I think the one thing that I thought was interesting now, if you go, this is today, look at staples and healthcare, how much separation they have achieved versus materials and industrials. These two are actually now in an underperforming relative strength position, whereas even though we got the momentum fall off of materials, industrials, and financials, materials and industrials still holding on to high relative strength. That's why I believe there's still some opportunity within these two indexes for these to pick back up and make another push, potentially back up in the leading quadrant. So I'm not wholesale exiting industrials and materials at this point. And then we did call the energy fade here, and Todd has rebalanced his portfolio to more of a neutral position in energy, correct?
Hey, Terry, back, and one thing we have to note for ourselves when we go into the member webinar, steel stocks within materials. We noticed yesterday there's been some rippers in there. Look at Nucor, look at US Steel. There's the steel sub-industry within materials is moving. So we're going to be monitoring that.
Right. That's what we do with our clients. We drill down inside the industry subgroups within not these sectors, and then we'll look to see which industry groups are also. We'll do these similar rotations, and we use screens and other tools to help us locate the best stocks to trade within there. We did talk about this last week, and I'm just going to repeat it and reiterate it. Last week, I think you were seeing everything green. This week, you're seeing everything red. But, the absolute value of the percent price change between these sectors still does not negate the fact that you've got growth accelerating to the northeast, which means gaining relative strength and gaining momentum simultaneously against the value trade. This is something I want you to note. I'm going to back this up. At this point right here, you actually see these two vectors moving in opposite directions, right? You see value accelerating, growth decelerating. At this point right here, these two are now moving back together. So there's this, I don't know, this rotational effect is actually bringing value and growth back in line with the S&P, right? At some point, these two will cross evenly here. But if you wait that long to get back into the growth stocks, I think you're really going to miss out on the trade. The key factor is these turns, recognizing that there's a paradigm shift in behavior, and that occurs when you do see the change in direction of these two guys. Now let's talk about the market cap. I'll bring this over here so you can at least see the titles of what these things are. Well, I guess they're on there. The titles are there. And we mentioned this at small cap. All three categories of small cap value, mid cap growth, small cap growth, and large cap growth, all three categories of growth are moving up and to the right. And small cap value is the odd man out, right? Because the mid cap value and the large cap value are these two that have been shedding, and I think that's why you see most of the sector shedding. But if you were to drill down into, and I think Todd, you've got a symbol for the small cap for different sectors in the small caps.
Yeah,
I'll have to get that list from you.
Invesco puts out a small cap sector list. It's yeah, I'll send it to you.
Yeah, I think that would be, because I'm usually just only focused on what's happening in a large cap, and I think you can take advantage of those ETFs that those companies have put together for small and mid cap sector movement, and we can take a look at that too. But yeah, you've basically got four groups of stocks that you should be focused on for putting money to work at this point in time, right? And then you should be looking at reducing positions in mid cap and large cap value as we've seen there.
Right.
So that's all I've got, Todd. Unless you want me to cover anything else, I'll give it back to you.
That's very fine work, and good job turning the camera back on. And yeah, I just exact same thing. You were showing Dow Jones, I think, value growth and various market capitalizations. This is the iShares version of it, and this is the kind of move. This is where Terry and this is where the heart of our research process right now in the first part of the week begins, is finding these moves that are kind of happening, bubbling below the surface. As we've said, almost every video communication, it's the mid cap and small cap. Look at just the dynamic move that we're seeing here in Russell mid cap and the Russell small cap. And just recently is that large cap growth starting to move. Value is rotating out.
Now you're on the monthly time frame. You're seeing that same thing on the monthly time frame that we're seeing on the weekly, and that's a good thing for us because that marries those two time frames together and gives us much more conviction that we're going to be in it for the long haul.
Right. So, and that's the key. And that's why I think people just traders and investors need to realize that we're in a range in the S&P. And I'll show you at the end. I want to flip it over to Alex here, get the macro view. But we're in a range because value is rotating out. Large cap growth has gotten smoked, is starting to pull itself off the map. But what's happening is the small cap and medium cap consumer discretionary, comms, and tech are moving. So, Alex, what's going on in the macro world, dude?
Well, nothing much for now. So I'm gonna.
What do you mean nothing much? Tons are happening, dude.
I mean, in a sense that let me share my screen. So
we gotta get Alex a mouse pad, Terry.
Yeah, I have to just go over this Windows. Let me just do this. Just a second.
You want a second, or are you good? Okay. We had I'll tell you what, I'll take it, and when you're ready, just grab me, okay, Alex?
Sure.
Okay. So who is asking? So two things. Scott M over on the Trading Analysis YouTube channel is asking a leading diagonal. Yes. I have as a leading diagonal in the S&P. You're absolutely right. So the way it works is 1 would be the longest. Here's 2, wave 3, and a traditional Bob Prechter, Elliott Wave interpretation is 3 would be the medium length and 5 should be the shortest. So 5, if it happens, needs to stay below 43.77. That's 100% 5e3. The NASDAQ's a little different. For several reasons, I did not put a diagonal on the NASDAQ. Because that same reason, if I put the diagonal here in the NASDAQ, the top of wave 1, 3 would be longer than 1. And Bob, I love him. He's a friend. I'm happy to call him a friend, and we've worked together for a good 2 years. He would say in the traditional sense, 3 can't be longer than 1. So therefore, I made the NASDAQ running flat. So wave 2. So 1, ABC and 2, 3. 4 does not close within this wave 2 territory. The orthodox top is B of 2, but here is the borderline 11,668, and you see wave 4 did not move into that. So I'm using the NASDAQ as a little bit more of a traditional motive. It's actually an impulse. And again, the higher degree 1, it's wave 1. It's just getting off the mat. I don't care if it's sloppy and choppy and there's some overlap. You'll never see me break any rules or take any liberties, I should say, in a higher degree 3rd. You're always going to see me have a good, clean motive, impulsive wave in wave 3 with no overlap, no interaction between 4v2. Waves, wave 1, a higher degree 1, it's a little bit different, okay? So hopefully that helps. And then the last thing is, I am aware of the bear scenario, and we are prepped for it. And I'll just give you a quick look at it. It is still a triangle. Probably takes you into the summer. But if it is a B wave triangle, we are looking at 3,200. And that's what we're looking at. Alex, you good?
Yeah.
All you.
Okay, guys. So let me start with the dollar index. So I'm still looking for this to get more complex. I do see potential 5 waves down. So on a larger time frame, dollar index has completed 5 waves up. So if we look the weekly time frame, we can see that from 2008 GFC, we have completed one of the cycles on the upside. So I do expect a little bit more strength back and forth in dollar index, and that's in line with the chart of the 10-year yields that you have shown. So if we start reaching a touch lower and then continue a little bit higher towards this 5.25 range, that will also manifest because the Fed was progressive with rates. We have a couple of central banks, major central banks, still very late on rates, especially in Europe. Europe is at 3% now, and it's going to keep pushing rates further on the upside, although the situation in Europe is much more different in the economy than in the US. But I don't see ECB stopping because of the higher rate of inflation in Europe than in US. So in that respect, I do see this as a B wave. Maybe Fed is in the late of the cycle in rates to start pausing, and I think CPI will be very important. If we see that moving lower next week to, let's say, 6.26 and 5.9, which means that the core will move from 5.6 to even lower. I didn't see any commodities moving higher, Todd. So oil, we track also the XLE. So, I mean, this is just a small consolidation, nothing impulsive. We might get a little bit more upside. This might be ABC triangle XA, or it's a B wave triangle, but definitely oil looks, it wants to go lower. But for this couple of weeks, nothing was happening with oil dramatically on the upside. Thomson Reuters index, on the other macro front where we watch commodities, it's just sideways to downside. So I don't see commodities contributing to this CPI further. Nonetheless, I see it contributing on the lower side. Although we are seeing data from 4 weeks, it's a lagging on this CPI, but I think it should go lower on the next reading, which actually should bring your chart on the 10 or our chart on the 10-year yields look little bit different next week. So oil, basically nothing, moving sideways to lower. Commodities moving lower. Dollar index might continue just a touch downside in this X wave. And I'm still gonna stay on that front, that we're gonna have a couple of weeks back and forth, and then I think this CPI next week and up to the May will hammer this other data that we have seen, and basically Fed might stop earlier, in my opinion, than they say. So let's look what's going on the European front. So yields are moving higher. This is the German 10-year Bund. I think it's going to move up to the end of the year around 3.75 to 4%, which is in line with current futures on the 1 month, 3 months, and 6 months Euribor. They're matching these expectations. So that's why also this dollar picture looks very bearish after this B wave. I think we're gonna drop down because the Fed is gonna pause first, and it's gonna start moving on this interest rate differential further lower. Let's just say that we have to also look what's going on in Asia. So Japan and China injected over $1 trillion of liquidity from October to now, and Japan is still on a 10-year between 0.25 and 0.50 range. So I think lots of carry trade has been going on, and that most likely is going into US markets and a little bit in the European one, in my opinion. I will also show you a couple of stocks that we have, and they're exactly from this smaller range that you have shown. I just have to restart this and then share.
Yeah.
Put my stock screen on.
You all right?
Yeah, I'm fine. I'm just putting my stock screen on the display. It's coming right now,
Okay.
and I hope you see my screen now on the
Yep.
stock side.
Yep,
Yeah.
we got you.
So,
Good.
couple of things here. We selected. We every week we have a process of selecting the stocks for our members. I noticed a couple of stocks, and for this we're going to show you this ZOS. It's Olympic steel. You already mentioned the steel that it's moving on the upside, so I'm going to show you a selected stock we have for our members. So this looks very nice, in my opinion, technically. So 5 waves up with a pullback down in a wave 2.
Wait. Before I love this, and we were looking at this in the member webinar. This goes back to the conversation Terry and I were having with materials, and this is a steel stock. This is a smaller cap steel stock, and I'm saying, like, if you have a ticker symbol Zeus, how do you not just buy the stock anyway? But then you put a chart pattern like this with rotation and sub-industry rotation like we're seeing here. This is a good one, Alex. This is a good pickup.
Yeah, I mean, we have 5 waves up and a pretty sizable correction, and then we have a 5 waves up trading above 200 moving average. Combined with Elliott, we have a 5 waves up and a pullback to that 200 moving average and impulsive resolution higher. So I think this one is good to go further on the upside. So I think
coincidentally, we happen to have a viewer today whose handle is Zeus. So here's buy your name.
Yeah. I saw that. Zeus, are you still in the house? And you know, Zeus asks on the trading analysis channel, what equities you bullish on? This is your lucky day, man. Zeus. Keep going, Alex.
Yeah, so this stock is from semiconductor. It's Lufus, and also very nice Elliott Wave pattern combined with the 200 moving average. And I do see here very nice post fourth wave, 5 waves on the upside, and ABC pullback down. So I think this one is also potentially preparing to continue higher. I'm watching for a 5 waves up for a small confirmation on the upside. But even if this gets more complicated, I think we're going to monitor these developments. If we see a breakout above 786, a little bit more upside pullback is definitely viable for me. And then the third stock, and we have much more for our clients. All stocks are to be presented there. It's a Chipotle. I'm looking this triangle in Chipotle, Todd. It looks like we might come to the end of this triangulation here. It's a tricky one, I know, but if we see a, yeah.
It's a great pattern, and I'm sorry to interrupt. It's just, I'm not afraid of a lot of stocks, but for some reason, Chipotle and Ulta, those two stocks, those are just such big price hedge fund momentum stocks. They've always scared me.
I agree.
Anyways, no, but please continue. It's a solid setup, and you know, it's consumer discretionary is rotating in, as we've mentioned a couple times in the show. I mean, it's a very valid setup.
Yeah, technically it's valid setup. If we want to see more confirmation, we can wait 5 waves up, and then we can also. So wave count invalidation here is very close for the C wave, and then. If we want more certainty, in a sense, we can also wait 5 waves up. And the last one, it's also Costco. We have been watching this for some time, and I think this one is good to go. Also a nice triangulation here, a very long triangle from March 2022, and now after a post E wave, we have a 5 waves up. So very small stop loss, very small risk. And we have a bunch of other stocks for our members today, so it's going to be a long one.
Yep. We have some very, very fun stocks. Is there anything else you want to show, Alex?
Yeah, that's all for today for the public.
Okay. Yeah, flip your camera back on.
Sure.
Yeah, there's some good stocks we're tracking. There's, you know what, Alex, we got to show. I love this one that you picked up. Alex has been moving into covering the Elliott Wave analysis of stocks that we're tracking. We go through a macro analysis process, then we go through a sector and industry rotation process, find what rotation is happening based on what's going on in the underlying fundamentals, economy, the sentiment, you know, what themes traders and investors view to be driving this market. And Terry and I will go to work and bring up the best stocks, put them in front of Alex. We have a process. Alex goes through and does exhaustive Elliott Wave analysis on a bunch of stocks. And I mean, I hate to let this one out, but I have to. I'm proud of you for finding this stock, Alex. This thing, we're going to be watching this one very, very carefully, which is a industrial, unmanned, aerial. Terry, help me out here. It's a drone company, not very political.
Yeah, I mean, they make military drones, right? So.
Not very politically correct, but talk about one of the prettiest wave counts I think I've seen in some time. You have a beautiful wave 1, ABC, deep directional correction here in wave 2, right to the 786. Then you go into 1, ABC expanded flat. Beautiful 3 of 3. And remember, I was making the point, guys, you'll never see me have, at a higher degree third, any interaction between wave 4 and 2. Same thing at a smaller degree. No interaction between 4 and 2. And you can even break wave 3 down into a smaller 5 wave move, go up in 5 of 3, choppy A of triangle 4, and then even E itself becomes a triangle. This thing is in a consolidation, really, that began back in 2018, but since 2022 in the summer. If this thing goes sorry for the bad pun, but this would explode higher. And this is something we're watching. This is something that Alex came up with on the scans and the wave counts. I wanted to show that one in Bragg there, Alex. One more stock that we are carrying with our members is AXON, a similar industry stock. This one is beautifully breaking out here. Got through 200. Terry, where are we long from? We're long from 180s.
From that internet marker there on the box on the right.
Yeah.
I can't see the resolution, but the bottom of that red channel over there.
Yeah, this is another one we're watching. So we're through the 100%.
We've moved the stops up into profit. So.
Yeah, stops at 199, and there's still more room to go. If you look at wave one, there's a big old sell here in AXON. No news. Somebody just came in and crushed the stock. Held wave two lows, and now we're moving higher in wave three. 100% was cleared at 212. The 1.6 minute relationship is at 245. One more thing. So we do stock trades. We also do option trades. Alex, let's talk about this. I'm just extending this a little bit. Then we got to head into the member webinar. Do you want to talk about XLE? So where are we? We talked about the macro. We talked about energy. XLE is in kind of a funky sideways triangle. Alex, do you have any updates to where you are here in energy?
Yeah, that's the update actually. I'm still expecting this C wave triangulation because to unfold for a little bit more time, and then when everything is set up, I think we're gonna continue higher. So as you can see, we are still going back and forth. As you know, with triangles, we don't still yet know where it's gonna complete. But I'm looking a couple of options. I think we're still gonna stay sideways, looking oil charts to go lower. I don't think this one will go for next couple of weeks in any direction, in my opinion.
That's perfect. That's perfect. So this is XLE, the energy ETF. It's rotating out, as Terry showed in the beginning. Good rotation out, but it's still holding a good technical triangle. So we have an option trade on. I don't mind showing it to you here, and we'll jump in. Oh, look, I'm up $300 today. Nice. If we go to analyze, so we have a XLE, we have a butterfly on, and what we'd like to do is pair up option trades with good Elliott Wave patterns, whether you're trading options directionally or non-directionally, either theta positive or theta negative, depending on what the wave count is. So if XLE is in triangle consolidation, I'll show you what we have on here with our members. We've got a 31 March call butterfly. It's a balanced butterfly. So the body is at 86. I'm short 20 of the 86s, and I'm long 10 of the 83s, 10 of the 89s. Theta is starting to pick up here. This guy expires in about 3 weeks. So we're looking to exist between 83 and 88 in this option structure. And again, that's going to tie in pretty well with the wave count here in XLE, trying to get out into the end of March, which would be right here between these two triangle boundaries. So, as you get out in time, the theta starts to kick up, and the decay of those 86 calls will start to pick up, and that's the profit and loss line here. So a little option trade that we have on, and it's quite possible that we are sideways. As we mentioned, the whole dynamic is rates are uncertain. Large caps growth is trying to get off the mat, still beaten down. Values rotating out, leaving those indexes sideways. So we're kind of keen to go to theta positive option strategies in the indexes and large cap in sectors, but looking for very interesting small and medium cap ideas within sectors and industries that are rotating in below the surface. So this is a trader's market. So that's why I jumped on you, Alex, in the beginning when you said, what's going on with you? And you're like, not much. Dude, there's a lot going on.
Yeah, I mean, not much from the last night up to morning. So.
Well, no, I mean, listen, look at yields. I mean, 10-year yield is
Yeah.
down to 3.91. I mean, we tried to get above 4. The last 2 days, we tried to get back above 4 after the initial 4.1 test. We just failed, and now we're sitting back at the lows after Powell just came out and tried to hammer us over the head again.
Yeah, but as he's going to speak again today, so.
Yep. Yep.
And CPI, we also have a non-farm payrolls at Friday.
Yep.
So that one also should be monitored. Yeah, I still think they didn't form their firm opinion. So let's see CPI.
Let's see CPI. Yep, I agree. All right, we should probably end it there. I feel like there's one more thing I want to share with you, but we should probably let it go at this point. All right, yeah, we're going to put a wrap on that. Good show, guys. Thanks for all the participation. If we didn't answer questions, I think we'll get you next time. All right, check us out, tradinganalysis.com. We're heading to the members webinar in 8 minutes, guys. Bathroom, coffee break. If members are here, we'll see you in 8 minutes. Terry, Alex, great job, guys. Thanks.
All right. See you guys
See you
next
guys.
week, guys.
Bye-bye.